Hello and welcome. In this discussion, brought to you by the experts at ProTax Accountant, we're going to tackle a question that so many people think about. When you give a cash gift, how does HMRC actually find out about it? Let's dive in.
You know the feeling, right? You've helped out a family member, maybe with a deposit for their first flat, or given a generous wedding gift, and then this little thought pops into your head. Is this going to show up on some government radar somewhere? Well, it's a really valid question, and today we're pulling back the curtain to see how it all works.
So, we're going to get right into the systems, the rules, and all the key numbers you need to know updated for the 2025-26 tax year. By the end of this, you'll have a much clearer picture of how HMRC operates, and, more importantly, how you can be smart with your gifting and stay completely on the right side of the law.
So, where does an investigation really begin? Well, it's not about spies hiding in the bushes, I promise. The reality is a mix of legal duties and some incredibly powerful technology. Let's start with the most direct route HMRC has to this information.
The number one way HMRC finds out is actually pretty simple. They get told. The whole system is built on people declaring things themselves. You see, when someone passes away, the executor of their estate has a legal obligation to fill out the inheritance tax form, which is called the IHT 400. And on that form, they have to declare any big gifts that were made in the 7 years leading up to the death. It's their job to get it right, and believe me, the penalties for getting it wrong can be pretty serious.
And this, right here, is the million-dollar question, isn't it? What happens if the executor just didn't know about a gift? Or maybe, what if someone conveniently forgets to mention it? Well, this is where a lot of people really underestimate HMRC. They don't just rely on honesty. Stay with me here because what comes next might genuinely surprise you.
Meet Connect. Now, this isn't science fiction. It's a massive, powerful data system that HMRC uses every single day. The best way to think of it is like a digital super detective. It constantly sifts through billions, and I do mean billions of pieces of information from all over the place. We're talking bank accounts, property records, car registrations, and yeah, even public social media posts. Its only job is to piece together a financial puzzle for every taxpayer and spot the anomalies, those little details that just don't quite add up.
And Connect doesn't work alone. Banks, for example, are legally required to flag large or suspicious payments. So that £50,000 transfer to your son for a house deposit? Yep, that could get flagged. If money moves overseas, the Common Reporting Standard means that banks in over 100 countries automatically share info with HMRC. When you add in public property records and the fact that people can and do submit anonymous tip-offs, you start to see just how wide that net really is.
Okay, so we know how HMRC can find things out, but why are they so interested in gifts you might have made years ago? Well, the answer lies at the very heart of inheritance tax, and it all comes down to one crucial time frame: 7 years.
This brings us to a really important term, the potentially exempt transfer, or PET for short. When you give a cash gift to another person, it isn't automatically tax-free, it's potentially tax-free. The moment you make the gift, a 7-year clock starts ticking. If you, the person giving the gift, live for those full 7 years, then bingo! The gift becomes completely exempt and is no longer considered part of your estate for tax purposes. You can think of it as a countdown to safety.
But, and this is a big but, if you don't make it through those 7 years, the stakes get very high. For the 2025-26 tax year, every person has a tax-free allowance of £325,000, but anything in your estate above that amount is taxed at a staggering 40%. And here's the kicker. A gift made inside that 7-year window gets pulled back into the calculation, which can easily push an estate over the limit and trigger a massive tax bill.
Okay, now for a little bit of good news. The system isn't completely all or nothing. If you pass away between 3 and 7 years after making the gift, something called tapered relief comes into play. As you can see from this table, the tax rate on the gift itself starts to decrease on a sliding scale. After year 3, the tax bill starts to drop. It doesn't get rid of the tax completely, but it definitely softens the blow the closer you get to that 7-year finish line.
Right, that's enough of the risks and the theory. Let's get practical. How can you be generous to your loved ones without falling into all these tax traps? It's time to look at the essential tools you have for tax-free gifting.
This is your number one go-to tool, the £3,000 annual exemption. Every tax year, you can give away this much, and it's immediately and completely exempt from inheritance tax. And here's a great pro tip for you. If you didn't use last year's allowance, you can carry it forward for 1 year. That means you could potentially give a £6,000 gift in one go, totally tax-free. Imagine you're a freelancer in London helping your child with a year's worth of rent. This is perfect for that.
But that's not all. You can also make small gifts of up to £250 to as many different people as you want in a tax year. The only rule is that those people can't have also received part of your main £3,000 allowance. And for weddings, the allowances get really generous. A parent can give £5,000, a grandparent can give £2,500, and anyone else can give £1,000. These are fantastic tools for those big life events.
Now listen up, because this one is a real game changer and it's often overlooked. It's called the normal expenditure out of income exemption. Basically, if your income is consistently more than your living costs, you can make regular gifts from that extra income. And here's the amazing part. There's no upper limit, and they can be completely exempt from inheritance tax. But, as you can see, you have to tick all three boxes. The gifts must be regular, they have to come from your income, not your savings, and they can't reduce your own standard of living.
The absolute key word here is proof. If you want to use this powerful exemption, you need to be able to prove it. The best way to do this is to set up a standing order, which creates a clear, regular pattern. And alongside that, just keep a simple record of your income and your expenses. This gives HMRC the clear evidence they need to see that these gifts were genuinely from your surplus income.
So, you're using your allowances, you're keeping good records, fantastic. But gifting can seem simple on the surface, and there are some common pitfalls that can be really costly. So let's look at where people often go wrong, because these mistakes can undo all of your careful planning. Let's talk about two of the biggest traps. First is the gift with reservation of benefit. A classic example is signing your house over to your kids, but then continuing to live there without paying any rent. In HMRC's eyes, you haven't really given it away if you're still benefiting from it, so the house is just treated as if it's still part of your estate for tax. And for business owners, there's another risk. Gifting money straight from your company account is a no-no. HMRC might just see that as an undeclared dividend or salary, which opens up a whole other can of worms. You need to draw the money personally first and then make the gift.
Theory is one thing, but a real-life case really shows the consequences of getting this wrong. Let's look at a story that serves as a very stark warning for anyone who might be tempted not to disclose a gift.
This quote comes directly from a real case, Hutchings versus HMRC, and it gets straight to the point. After his father passed away, the executors asked all the family members if they'd received any gifts. This son deliberately chose not to mention a very large sum of money he'd been given. The court was clear. This wasn't an accident. It was a deliberate choice to hide the information.
And the gift wasn't a small amount. We're talking about a whopping £450,000. The only reason it came to light was because, nearly 2 years after all the tax forms had been filed, HMRC received a tip-off. It just goes to show that information can surface long after you think a matter is settled, and often from a source you'd never expect.
And this is where it really hurts. The son, of course, had to pay the £47,000 of inheritance tax that was due on the gift. But on top of that, HMRC hit him with a penalty of £87,000 for deliberately withholding the information. That's a penalty almost double the amount of the tax itself. It's a very powerful lesson that trying to hide something is just never worth the risk.
So, we've gone through how HMRC finds out, the rules you need to follow, and the very serious consequences of what happens when things go wrong. If there's one clear takeaway from all of this, it's that planning ahead is absolutely everything.
Look, the rules around gifting and inheritance tax can be really complex, with lots of little traps that are easy to fall into. But with the right strategy in place, you absolutely can support your loved ones in a tax-efficient way. This just isn't a one-size-fits-all situation. It requires advice that's tailored specifically to you. So, where do you go for that? For that kind of expert, personalized advice, you should get in touch with the team at ProTax Accountant. This is what they do, day in and day out. You can reach them on WhatsApp or by phone at 079 856 89912, or just drop them an email at info@protaxaccountant.co.uk. And please, just remember, the information we've discussed today is for general guidance. It's no substitute for getting professional advice based on your own personal circumstances. Thanks so much for joining us.